All right, let's get right into it. Today, we're cracking the code on the balance sheet. It's one of the most powerful financial documents out there, but let's be honest, it can feel a little intimidating. My goal here is simple. By the end of this explainer, you're going to know exactly how to read it. I love this quote because the financial X-ray analogy is just perfect. It's not just a surface level picture, it lets you see right through to the bones of a company, its strengths, its weaknesses, maybe even a few hairline fractures. So today, we're going to give you those X-ray glasses or turning this thing from a confusing document into a serious tool for clarity and power. So here's our game plan. We'll start with that big picture idea, the financial X-ray. Then we'll lock down the one single equation that holds this whole thing together. After that, we'll break down the two big parts, what a business owns and what it owes. Then, and this is the juicy part, we'll dive into some really common and really costly mistakes. And we'll wrap up by talking about why getting this right is your secret weapon. Okay, so first things first, what is a balance sheet? The most important thing to remember is that it's a snapshot. It's a photo taken at a single moment in time, say midnight on December 31st. It doesn't show you the company's performance over the whole year. It just tells you, here's exactly where we stand financially on this specific day. Now, every single balance sheet in the world, whether it's for a tiny startup or a massive corporation, is built on one single unbreakable rule. This is the bedrock of accounting. If you get this one thing, you're already halfway there. And here it is. Assets equals liabilities plus equity. This is it. The whole game. It's called a balance sheet for a reason, because these two sides have to balance, to the penny, always. The total value of your assets must equal the total value of your liabilities and your equity combined. If it doesn't, something is seriously broken. Let's make that even simpler. Think of it like this. The left side, assets, is all the stuff the business owns. The right side, liabilities plus equity, is how you paid for all that stuff. It's what the business owes. You owe money to outsiders like banks, that's your liabilities, and you owe a stake to the owners, that's your equity. So what you own is funded by what you owe. It's a perfect mirror. So let's zoom in on that first half of the equation, what a business owns. Let's talk about assets. So what counts as an asset? Well, pretty much any resource that the company owns or controls that has economic value. We're talking about the obvious stuff, cash in the bank, inventory sitting in the warehouse, the machines on the factory floor. But it can also be things you can't touch, like patents or trademarks. If it has value and the company owns it, it's an asset. Now, assets aren't just thrown onto the page randomly. They're organized by liquidity, which is just a fancy way of saying how fast you can turn them into cold, hard cash. So you have your current assets, stuff you expect to convert to cash within a year. Think inventory you're about to sell. And then you have your non-current assets. These are the long-term workhorses like buildings, land, and heavy equipment that you plan on holding onto for a while. Okay, so we've covered all the stuff a company owns. But where did the money come from to get all that stuff? That brings us to the other side of the equation, what the business owes. And this is where liabilities and equities come into play. So, liabilities are your debts to outsiders. This is the money you owe to banks, to your suppliers, maybe even to the government in taxes. Shareholders' equity, on the other hand, is what the business owes to its owners. It's what's left over. If you were to sell off every single asset and pay back every single liability, the pile of cash remaining, that's the equity. That belongs to the owners. And just like assets, liabilities are also split by time. You've got current liabilities. These are the bills you have to pay soon, within the next year. Think of payments to suppliers or your monthly payroll. Then you have long-term liabilities. These are the debts that are due way down the road, more than a year out, like a big 5-year bank loan. Okay, let's see what this looks like in the wild. Take a look at this example. Notice how it's structured? Up top, on both sides, you have your current items, the stuff that's happening within a year. And at the bottom, you have the non-current or long-term stuff. This isn't an accident. It's designed so you can tell at a glance if the company has enough short-term assets to cover its short-term bills. It's all about immediate financial health. So that's the theory, a perfectly balanced, logical structure. It's beautiful, right? Well, in the real world, things get messy. Even when the sheet balances perfectly, the numbers inside it can be telling a very misleading story. So let's talk about how that perfect picture gets distorted. And you might be thinking, hang on. If assets always have to equal liabilities plus equity, what could possibly go wrong? It seems foolproof. But here's the catch. The danger isn't that the sheet won't balance. The danger is that an error on one side gets hidden by a corresponding error on the other side, creating a picture that's balanced but totally wrong. Okay, here's a classic mistake, and it happens all the time. Imagine a company has a big loan, but a chunk of it has to be paid back within the next 12 months. It's the end of the month, everyone's rushing, and oops, the team forgets to separate that current portion out, and the entire loan gets classified as long-term debt. And this is what that looks like. See that? The line for bank loan, current portion, is 0. The full 60 grand is sitting down in long-term debt. The balance sheet still balances perfectly, but it's hiding a ticking time bomb. It's hiding a near-term need for cash that just isn't being reported correctly.
So why is this so bad? Well, for one, it gives everyone a false sense of security. It makes the company look like it has more breathing room than it actually does. But when an auditor finds it, and they will, it can cause a company to suddenly violate its loan agreements. And it's a giant red flag that says, hey, the financial controls here are weak.
All right, mistake number 2. This one can quietly poison a balance sheet from the inside. A company is holding on to inventory that's obsolete. Think of a warehouse full of last year's cell phones or sweaters from 2 winters ago. Instead of admitting that stock isn't worth much, they keep it on the books at its full original cost. Just look at this. The company has 500 units of this old ZX201 model. Realistically, they probably can't sell them, but they're still valuing them at over $22,000. This is what we call an asset bubble. That number is pure fiction, and it's artificially inflating the total value of what the company owns. And the fallout from this is massive. It makes the company look more profitable than it is until reality hits. And when the company is finally forced to write off that dead stock, profits suddenly tank. It's a nasty surprise for investors, and it sends a signal to everyone watching that management might not have a good handle on the business.
So, this brings us to the most important point of all. Getting this stuff right isn't just about dotting your I's and crossing your T's for an audit. It's about building real strategic strength. An accurate balance sheet is, without a doubt, a massive competitive advantage.
I mean, this quote just says it all. Precision isn't a luxury, it's a competitive advantage. When your numbers are rock solid, you make smarter decisions. Lenders trust you more, which means you get better rates on loans. You allocate your capital more effectively. You send a powerful message to the market that you are a well-oiled, well-managed machine. That precision is power.
So I'll leave you with this one final thought. A balance sheet is never just a page of numbers. It's a narrative. It tells a story about a company's stability, its strategy, and its future. It's a story about where that company stands right now, in this moment. So the question is, what story is yours telling? Thanks for joining me.